Good morning and welcome back to Almus Market Mornings, your daily dose of global financial update. It's a talk of economic data. On the European front, inflation, especially core inflation, was down, and not just that, economies within the Eurozone seem to have put a decent show. German retail sales data came in strong, beating expectations. On the US front, we had the PCE numbers, which is the Fed's preferred inflation metric, broadly in line with expectations and lower than previous month. And jobless claim also came in slightly lower. Amidst all this data, we had a strong show put up by India, but UP did not feel any impact. Good morning, JK. A lot of data to chew on. Break it down for our listeners, please.
Good morning. So we ended the month of November with a lot of good data for the economy, more particularly for the markets. The most preferred gauge of inflation for the Fed, measured by the personal spending, increased in line with the expectations, possibly giving the Fed more incentive to hold rates steady and perhaps even start thinking about cutting rates next year. The details were also encouraging that the core goods was just 0.3% down from 4 points. It was actually 0.3% down from 4.6% in October last year. And given Fed's concern over services inflation, it had a good news in core services ex rent as well. Personal income and spending also rose 0.2% on the month, meeting the estimates. But they were, of course, lower compared to what it was in September. The slower spending growth, of course, aligns with the Fed's goal of cooling the inflation and also the demand, which we are seeing to be meeting. So while the public generally closely watches the Labor Department's Consumer Price Index monthly number, Fed prefers a PCE core reading because that looks at what the people actually spend on, adjusting for consumer behavior when the prices fluctuate. Yes, the jobless claims also came at slightly higher end, though 2,000 below the estimate. But the continuing claims, which run a week behind, surged to 1.93 million, an increase of 86,000, the highest level since November 27, 2021. And this is good news for rate watchers looking for dovish spread. So once again, to elucidate, the continuing claims rising means that people who go out of the jobs continue to claim the jobless benefit, and they are not able to find new employment as well. On the Eurozone, annual inflation cooled to 2.4% from 2.9% in October. As per the flash information, the core inflation, as I said, also was down. Energy prices continued to log significant year-on-year declines, coming down 11.5% in November on a year-on-year basis. Now, the headline inflation has cooled significantly from peak levels of 10.6%, which was seen in October 2022. And the inflation in the two largest economies, Germany and France, has dropped, to 2.3% and 3.8% respectively. The ECB officials are too early to declare victory over price rises in that Eurozone, as they monitor the potential pressures from wage increases. In fact, they have also hinted that the base effect advantage may diminish in the coming months. The German retail sales was a good number, but then there was also a much sobering number from France, where the GDP for July-September quarter was a contraction of 0.1% versus 0.1% plus that was expected. So the financial markets now bet that ECB will on likelihood start cutting in April, and they see an almost 50% chance of even a reduction in March. When just over a month ago, the expectation was for the first reduction in June. Pressure is building on ECB as inflation tumbles and key Eurozone economies such as Germany and France flirt with recession. If you look at the bond market, what we saw yesterday was a buy rumor, sell fact behavior. Yields had been falling on expectation that inflation will come down. Actual numbers confirm that Eurozone and US are actually down in terms of price pressures. That's why we saw bond portfolio managers taking profit, but it did not rise much. Even though the fall in the last 1 month has been as much as 80 basis points in 10-year in US and 60 basis points in German bonds. And consolidation and waiting for more evidence of inflation sustainably cooling is necessary. before we see any further fall in the yields. Probability of a rate cut in May 2024 by the Fed has risen to 76% now. Now, amid all this, we should not ignore what the central bank has been saying. The profit taking was prompted by statement by Fed member Williams, who warned that markets are mispricing Fed's reaction function. Now, interestingly, just listen to this. Williams says persistence of easier conditions may prompt further policy action. Now, this is just opposite of what Powell was saying earlier a month ago. If financial conditions remain tight, further actions may not be necessary. So that's a big contrast that we have seen over the last 1 month. And similarly, then ECB member Mr. Nagel was also cautioning the market about pricing in rate cut, and he was in fact saying the policy might further tighten in the Eurozone in the form of the QT, which they have been postponing in view of the delicate situation in Italian finances. Now, also heartening for the market was the oil prices falling more than 1% after initially climbing 2% in the day. The down move came as there was disappointment over the extent of output cuts announced by them. It was in fact reported that members of the Broad Alliance would soon announce their own separate oil production cuts. So, according to the reports, the cut will be announced on a voluntary basis, and there will be no consensus. So, these, of course, have also led to a very benign atmosphere for the markets, although yesterday's specific price action saw profit taking both in the bonds and in the currency. The dollar index, in fact, has risen about 1% from its recent low of 102.47. Euro, which carries the big weightage, fell through 1.09, once again on profit taking, and also possibility that ECB may be on to more cuts, and maybe earlier than Fed as well, compared to previous expectations. Yen holding its stronger level indicates a reaction to the yields falling substantially. Even similar case with the gold as well. So overall view for rates to come down next year is not something quite predominantly ruling in the market. If you look at the stocks, the Dow Jones actually went up by nearly 375 points, and that was on its own track. The investors seem to be having a context of pushing Dow Jones also to the year's high, which the Nasdaq and S&P 500 already hit. There was no specific trigger for Dow to move so high, but then now we have all the indices trading near 2023 highs. And where do we go from here? We should get more clues from the non-farm payroll report next week, and then Fed meeting. We also have some possible Powell statements today when he participates in one of the events today. Yes, on the Indian scenario, once again, the rupee weakened to almost its all-time low of 83.42. Again, thwarted further fall by central bank selling, but this was down more to month-end buying by reportedly by a large foreign bank, and also, as well as outflows related to the recent IPOs, excess money being refunded. But the good news from the Indian economy was that we had the GDP number which beat the expectations, coming at 7.6% for the July-September quarter, and that was well above the market consensus of 6.8%. And the buoyant growth is being underpinned by cyclical factors like robust corporate profits, strong fiscal impulse, and government spending being front-loaded in a pre-election year, and a boisterous financial sector. The reading definitely represents some upside to the full-year GDP, but probably some moderation can be seen in the coming quarters as consumption is likely to slow after the festival season, and some slowdown in the credit growth is also expected. But overall, India is keeping up its promise of better growth picture in the global economy, which is still trying to recover. I mentioned about the state election exit polls. They indicated some surprises possible in the final outcome, some going in favor of the ruling party at the center and a few for others, but no particular common wave of voting pattern has been seen, at least in the exit polls. If the final results are to be in the same lines, then I think these results should not have any impact on the markets, and the stakeholders of the Indian economy will look forward to bigger political battle ahead in May. Now, what can we say about the rupee? It continues to be underpinned by central bank action as well as persistent demand. We are seeing some lower level in the USD INR in NDF market, but we really have to wait for market open, and if the demand persists, we continue to see the same ranges holding. However, as I mentioned earlier also, many funds, global funds, allocate fresh money into various markets in the month of December itself nowadays, and these can find some way into India, and it's only the large flows that can actually change the direction for the rupee. Otherwise, we contend with the same ranges again. Thank you and have a nice weekend.
Thank you, JK, for covering it so comprehensively. But the basic themes, if you look at it, inflation down across in the European zone, especially coming in lower than expectations, in the US in line with expectations, but still rising at a slower pace. Basically, inflation picture seems to be more under control, and in the US, the tight labor market seems to be easing. So if we look at how the data has come for US and Europe, markets are now pricing a rate cut in Europe starting April 24, a month ahead of what the market is pricing for the Fed. Now, earlier, what markets were pricing was a rate cut in June 24 for the EU region. So that's an interesting development that's happening, and we'll keep following that. However, central bankers, both Fed members and ECB members, seem to be cautioning the markets against pricing something extreme. Back on the basis of all of this, Euro saw some profit taking also, and adding on to the bets of the ECB rate cut starting next year. Rupee weakened almost to its all-time lows, but was curtailed due to the central bank interventions. Indian GDP beat expectations, coming at 7.6% for the July-September quarter. What JK mentioned about exit polls, some surprises are possible, and there does not seem to be any common wave of voting patterns. So we'll keep following these stories. Thanks for listening. Have a very good weekend, and tune in on Monday for the latest in the financial markets.